Welcome to tonight's event and thank you very much for signing in. My name is Tanner O'Connell and I work for a company called Elkstone who are quite active in the VC space, and I'm also on the board of the Irish Graduate Network. For anyone not familiar with us, we're a network for graduates and young professionals, and since our formation about 6 months ago, we've grown to about 250 members and are trying to grow that membership base out further. In terms of the running order for this evening, I'm going to do an in and around 45-minute interview with Brian, and then my colleague Avice is going to take over for the Q&A afterwards. So Brian, thanks very much for taking the time to speak to us this evening.
Not at all. Looking forward to it, Tanner.
To begin, Brian, you might give us an introduction and a little bit about your background and your early life, please.
Sure. So I suppose I'm a computer engineering graduate from Trinity College. I won't tell you when I graduated. It was quite a long time ago now, and I suppose actually you don't really think about it very much, but in retrospect, both computer engineering and computer science at the time were relatively new fields. In fact, I think the year I started college was actually the first year of the computer science degree program in Trinity College. At the time, to me, it didn't seem at all sort of strange to do a computer engineering qualification, and I think that's partly because from a very early age, kind of computers were sort of part of my life at home. You know, we would have been one of those families that had an Apple IIe very early on. We had the various kind of Sinclair machines and so on. So it didn't seem odd to me, but in retrospect, I recognize that was probably relatively unusual for the time. So after I graduated, I did some postgrad research for a couple of years, also in the computer science department in Trinity. I was working on one of these big EU-funded research programs. Very briefly had a real job working for a Swiss multinational, a small subsidiary of a Swiss multinational called Landis+Gyr, and I worked for them for, I guess, about 2.5 years before starting my first business, you know.
And was starting your own business, Brian, something that you always envisaged, or did you fall into it, or how did that come about?
I have to be honest, it wasn't a grand plan, you know, and I'm always actually a little bit suspicious of people who sort of believe that they have their life totally mapped out, you know, and you tend to see it a lot in the US, I think less so in Europe, but people will tell you, you know, I'm going to graduate, I'm going to work for a couple of years, then I'm going to do my MBA at a top school, then I'm going to work for McKinsey for 2 years, and then I'm going to start my first business, you know. And you know, to be honest, I'm a great believer that life doesn't really work like that. And actually, there's a professor in the Stanford Graduate School of Business that tells a great story about his son. And his son is a professor in Carnegie Mellon, and he explains that his son's CV says that you know, he got the opportunity to get an associate professorship in Carnegie Mellon, and that was a perfect fit for his research interests, and it gave him the opportunity to, you know, pursue his core research focus and all of that kind of thing. And he then goes on to say, but what my son's CV should have said is, moved to Pittsburgh for girl, and I suppose in some respects the story of me starting my first business is kind of a little bit like that. I was working for a subsidiary of Landis & Gyr, as I mentioned. Landis & Gyr was at the time about 2 billion turnover, 20,000 employees worldwide. 3 major divisions, 2 of which were loss-making, but the largest of which was building control, kind of heating, ventilating, and air conditioning control systems, had been very profitable and was kind of the cash cow of the business. And they were very late with a new product introduction in that business. They were beaten to the punch by a Japanese competitor, and the product, when it did come out, was probably overspec'd for the market. And suddenly the profitable division was in trouble, and Landis & Gyr were either selling off or shutting down anything that was non-core, and we were definitely non-core. So the business was essentially being shut down, and to me, it seemed at the time perfectly logical to, if you like, kind of try and buy the business or take over the business, and start trying to build our business, build a business ourselves. So originally there were four of us who were co-founders of that business. 2 dropped out along the way, and in kind of retrospect, I would say that my friends knew me much better than I knew myself. An awful lot of people sort of said to me that it's a crazy thing to do. I mean, starting your own business in 1992 would have been viewed as an act of lunacy, but it was kind of my friends who said to me, well, you were always a fucking lunatic, So it wasn't a grand plan, but I think that's actually true of a lot of entrepreneurs. An opportunity presents itself, or one of the characteristics of entrepreneurs frequently is in a situation where they're in a difficult place. Like I was being laid off, 1992 wasn't necessarily the best of times to be trying to look for a job in Ireland. One of the characteristics of entrepreneurs in that situation is that they'll frequently take more risk, whereas a lot of people will retreat to security.
Okay, that's interesting. And do you think it's something that you would have inevitably ended up going down that route anyway, had you not been, I won't say pushed, but kind of guided in that direction?
Yeah, I think I probably would have, if it hadn't been then, it would have been later, there would have been some other trigger or some other event that kind of, was the kind of thing that pushed me in that direction.
And Brian, I suppose that's kind of taking us forward to the stage of your life where you were involved as a founder or co-founder of several companies. Might maybe tell us some or part of the stories behind those businesses?
So I suppose the first business, the deal that we did with Landis & Gyr was that we could buy the business in inverted commas for 2 Swiss francs. What we actually got was essentially some furniture and some computers. That was pretty significant, though, because at the time, a kind of a decent PC with some extra memory was about $5,000. So it wasn't insignificant for us to have that to kind of start with. And the quid pro quo was there were some customers that they wanted us to kind of continue to provide maintenance services to, you know. So we were quite lucky in that respect to get that kind of start where we had a little bit of business from maintaining the existing customers, and we also had some, you know, some hardware and furniture and so on. We knew that we didn't want to be a services business. We wanted to be a product company. At the time, there was no venture capital industry in Ireland to speak of, and essentially what we tried to do was to fund our product development from kind of professional services work to doing kind of contract programming and that kind of thing. I think that's a very difficult thing. It was a very difficult thing to do then, and if anything, I think it's probably more difficult now because the pace of, you know, entrepreneurial businesses is much higher today than it was at that time. So I'd say that we kind of, in that business, we sort of bumped along the bottom for about 4 years trying to fund our product development with services work. And in 1996, we were probably one of the first very small Irish software companies to raise venture capital. We raised the enormous sum of 300,000 Irish pounds. It wouldn't even count as a seed round now, you know. I mean, these days, that's a kind of a big angel check. It's not, it's hardly around at all. But it was certainly the biggest check any of us had ever seen at the time. And we continued to build that business for another 3 or 4 years, reasonably successfully. We were kind of very much heading in the right direction.
Who were your early funders, Brian?
So the early funder, the VC investor, was actually Delta Partners, and at the time, Shay Garvey, who's now one of the founding partners at Frontline, was one of the partners in Delta Partners. So Shay led the round, and I have to say I couldn't say enough good things about Shay. You know, he was hugely supportive of the business and hugely supportive of me personally in, you know, occasionally some very, very difficult times that we went through. So I'd have a huge regard for Shay, and I think, in fact, one of the things you mentioned in the brief was kind of advice, and I think one of the most important pieces of advice is when you are choosing investors, you should focus much, much more on the character of the individuals that you're getting involved with than price or anything like that. And in fact, I'd go further and say that as an entrepreneur, you should be prepared to take a significant price discount to have the right investor rather than the wrong investor. You probably won't have to, but you should be prepared to. And I think that that sometimes gets a bit lost, you know. So anyway, that company turned into quite an interesting ride. We were growing reasonably nicely, heading in the right direction. It was into the kind of .com boom times. We ended up scheduled to merge with an American company called Paylinks, and Lehman Brothers, who are no longer with us, but Lehman Brothers were going to take the merged entity public on NASDAQ. So we were scheduled to go public on the NASDAQ market in May of 2000. And to kind of illustrate just how crazy a time it was, Lehman Brothers were telling us that we'd go public at $400 million market cap and more or less immediately trade up to $1 billion. And it wasn't, we didn't have to do anything for that to happen. We didn't have to achieve anything. It would just sort of happen automatically. And I was kind of sitting there saying kind of, oh yeah, myself and my wife will still own 16% of the business between us, even after the merger and the IPO. So that's like $160 million. Like that's not bad, you know. Unfortunately, the first big blip in the Nasdaq market happened in March of 2000. Paylink basically became nervous about what was happening, and they sold themselves to a company called CyberSource. And at that stage, we needed to either raise more investment, which was becoming increasingly difficult, or sell the business. So we ended up selling the business to a company called Trintech, which was actually founded by two Irish brothers, but largely headquartered by then in San Mateo in California. So sold to Trintech. Their stock price had been $75 a share. At Christmas that year, it was about $10.50. And I sold a chunk of stock. I remember saying to my wife, couldn't go any lower. And when the next chunk of stock came out of the lockup, it was 60 cents a share, which kind of gives you an indication of how abrupt the decline was as well, you know. So I still made a little bit of money out of that, and our investors like Shay Garvey and the Delta Partners guys made a reasonable but not spectacular return on it. So, you know, it wasn't a bad outcome. And I think one of the other interesting kind of things about that is that I think most really good entrepreneurs aren't exclusively driven by money, you know. It's kind of as much about self-actualization and solving a problem, and, you know, being passionate about a problem than you know, what's the easiest way to make money, you know.
At that stage, Brian, were you licking your lips in terms of being ready to go again, or were you slightly scarred by the fact that you thought the outcome was going to be so much more? Or what's your kind of mindset at that point in time?
Well, the funny thing is that I'd already had an idea for another business. One of our clients in the first business had been the Irish Credit Bureau, and there was a little bit of work that we'd done for the Irish Credit Bureau, essentially putting an AI system in to help them to evaluate responses. So a relatively early AI system, and that had kind of very much brought to my attention the problem of data quality, and the impact that data quality had on your ability to deliver systems like we had done there. So I felt there was a great opportunity in data quality, and in particular, at the time, most data quality software systems, firstly, were very, very technical. Data quality was seen as a technology issue, and they also focused almost exclusively on name and address data, because most of them had actually grown out of you know, large marketing companies that were doing lots of mailings. So they were very focused on name and address data. And I thought there was a great opportunity for, if you like, a generic data quality platform that broadened the scope, but that also made data quality a business problem rather than a technology problem. So I had that idea. I knew that I was going to be kind of tied into Trintech for a couple of years. And so I discussed it with Shay Garvey, and we kind of came to the conclusion that the only way that I could really pursue that business opportunity was if I found a co-founder to work with on it. And, you know, in one of those kind of really important pieces of good luck, because, you know, I think luck really matters in success. And, you know, there are people every bit as smart as I am, every bit as hardworking and committed, who haven't been as lucky and haven't achieved the same degree of success. But I was lucky enough to be introduced to a guy called Gary Moroney, and Gary actually had sort of been down the path of, he'd done an MBA, he'd worked for McKinsey for a few years, and was now looking to start his own business. So we basically teamed up, and Gary ran the business, Similarity Systems, as it became. And I was, I suppose, a little bit like a very, very active non-exec. I wasn't involved in day-to-day because I was a full-time exec in Trintech.
Mm-hmm.
And I mean, Gary is just a fantastic guy, and I would back Gary with my own money all day long. So we built that business over a period of 5 years, and I think we both, but certainly for me, I had a real sense that it had taken us kind of 8 to 9 years to do what we had done with Acceptus, which had been the previous business, and that there was a real opportunity to achieve that kind of and more much quicker. So we actually sold that business in just under 5 years, from foundation to a company called Informatica, who are a large data integration and extract, transform, and load business, you know. But Gary was the guy doing the hard work of sort of running that business day to day. And actually, the third business of which I was a co-founder was actually founded at around the same time. There was Professor Porrick Cunningham, who's one of the professors of computer science, now in UCD. At the time, he was actually in Trinity. He had a PhD student called John Carney, who had produced some fantastic early neural network technology, and had applied that technology particularly to predicting price movements of financial assets. The technology was absolutely first class, by far the best technology of the 3 businesses that I was involved in as a co-founder. So we started a company called Prediction Dynamics to commercialize that technology. Unfortunately, we got the go-to-market strategy badly wrong, and by the time we'd figured out what the go-to-market strategy should have been, our VC investors weren't prepared to back a change of strategy. And unfortunately, we had to put that business out of its misery in 2004. So that was a bruising experience. I mean, certainly one of the worst things I've ever had to do is myself and John went back to the office after kind of the final board meeting, where it had been agreed that we'd put the company into liquidation, that we had no choice but to put the company into liquidation, and told the kind of the remaining staff that kind of the journey was over. And I always remember one member of staff, breaking down in tears and being absolutely gutted. And it wasn't the loss of her job that drove that. It was just the sense of loss around the if you like, the project and the opportunity.
For you, Brian, what were the big takeaways or learnings from that not working out ultimately?
I think we weren't quick enough to absorb the lessons of interacting with customers. We should have been. If you think of, I don't know how many people in the audience will have heard of Eric Ries or will have read a book called The Lean Startup. He focuses very much on the idea that a startup is a kind of a machine to conduct experiments and to do that really, really rapidly and to iterate rapidly. And that does require some, you've got to exercise a lot of judgment in terms of distinguishing between things that you should really stick at and keep going with versus things that you should ruthlessly stop doing and changing. And I think the mistake for us was that we kept banging our heads off the same wall, whereas what we should have done was much, much earlier on kind of say, okay, this is not working as a go-to-market strategy, and we need to rethink the strategy. So I suppose fundamentally listening to our customers.
Brian, before we move on to talk about your transition to VC, what advice would you like to have had if you could go back and give it to yourself before you embarked on a career or your period as a founder?
That's a tough one. I think one of the challenges with advice, I think there's kind of, if you like, there's two kinds of advice. The very, very generic, where you have no detail of the real problem, if you know what I mean, and that's kind of along the lines of kind of be yourself because everyone else is taken. It's actually good advice, but it's incredibly generic. And then you've got the kind of very, very specific, where you really, really drill down into the details of a problem, and you're able, hopefully, to give some advice. I mean, I think in terms of the mistakes that I made and the things that I would have done better, I think I was really not sufficiently cognizant of the value of a rounded team and the importance of different skill sets, and really thinking through the different skill sets that you need to make a business work. I mean, the four of us as co-founders, apart from all being sort of white males, we were also all technical. And, I think technology people in particular can have a little bit of a blind spot around the importance of sales skills and marketing skills. So I think that's definitely something that I'd be much more conscious of now. I think if somebody is thinking about starting a business, I definitely encourage them to go for it, but not because they might make a lot of money, but more because if they think about it and don't do it, they'll probably regret it. I'd go back to that point of being really, really careful about the people that you that you end up in business with, whether as as investors or partners or whatever. And one thing that I'd be kind of critical of a lot of entrepreneurs on is that I think frequently they don't do, if you like, enough due diligence on their investors, and they maybe find themselves in bed with investors that are probably not a great fit,
Mm-hmm. And at this stage, Brian, you took, for what to me seems like quite a big decision, to move away from being a founder, startup land, to the other side of the table. Interested to know why you decided to do that and how it came about.
So I suppose I mentioned earlier on that I had a very, very positive experience of working with Shay Garvey. He had techniques that I didn't have in terms of thinking about the strategy of the business. He brought a level of discipline that perhaps I didn't have, and helped to create a little bit more structure and accountability. So that in itself I found hugely valuable. And if I was doing another startup today, I would want venture capital investors. I'd be extremely fussy about who they were, but I would want venture capital investors. And as I mentioned, we went through one situation which I won't go into, but was an incredibly difficult situation, and Shay was hugely supportive, and in fact put more money into the business at a time where his lawyers were probably telling him to walk away for various reasons. So I had a very, very positive experience of, if you like the entrepreneur venture capital model for building businesses. So a very, very strong view that if you like, that was the right model for building a successful tech company. I also felt that I'd kind of learned a huge amount, and that in some respects, venture capital might be a better way to kind of exploit that learning and that experience. I would say I probably thought in some respects that a kind of the portfolio approach that's embedded in VC might be in some respects a less risky way to make money. I was probably mistaken in that respect, in the sense that while it might be less risky, it's also incredibly long term, 10-year funds, and if you're very lucky, they might start to pay carry after 8 years, unless you have a total kind of bluebird deal. So that was really it, and I was very interested in the idea of getting into venture capital. I kind of hoped that maybe Shay might offer me a job, but sadly that didn't happen. But instead, I was approached by John Tracy, who at the time was the CEO of Trinity Venture Capital. Trinity at the time was the largest tech fund in Ireland. It was 140 million euros, which in the early 2000s that was a big tech fund. And John asked me to do a couple of due diligence assignments on a consulting basis. I didn't have the brains to realize that he was kind of road testing me to see if I'd actually be any good at this, And actually, interestingly enough, the very first of those assignments was on a company called Havoc, which went on to be very successful and was acquired by Intel for I think it was $110 million or something like that. So I did those two kind of consulting gigs for Trinity Venture Capital, and then John asked me would I be interested in joining the team, and I was very pleased to have that opportunity, So joined Trinity. I spent about 6 years with Trinity Venture Capital. Was lucky enough to be involved in some great deals and some great companies. Apona, which was ultimately acquired by Intel as well. Changing Worlds, which was acquired by Amdocs. I'm trying to remember some of the others, but anyway, a few good deals. Trinity then kind of changed strategy and actually went public, but went public with a view to becoming more of a kind of a holding company with a small number of large holdings, and also moving away from tech. And in fact, the first deal that Trinity did post the IPO was to buy a chain of 11 hotels, and that just wasn't something that like, I'm a tech guy, So I left Trinity in 2007, and naively left with the plan of raising my own fund. I did an interim CEO role for a short while, and then sort of built a team and went out looking to raise a fund in 2008. Kind of quickly realized that God himself could not have raised a first-time venture capital fund in 2008 as the world was sort of falling apart from a financial perspective. So ended up ultimately joining Draper Esprit in 2010.
We've had a lot of people reach out to us in advance of this, Brian, asking us about a career in venture capital generally. That's what they're considering. What does it take to break into it? What does it take to be successful? What do you look for in a potential venture analyst or venture associate?
So as you can imagine, that's a question that I get asked a lot. And, one of the first things that I usually say to people is there are probably about 30 real jobs in Ireland in venture capital. There are, a handful of good firms that have access to capital and, have been reasonably successful over time. And there are quite a few sort of wannabes out there that don't have that kind of framework or access to capital. So it's probably only 30 real jobs. And what that means is, to be honest, that it's pretty difficult to get into. And, there isn't an easily defined career path that's kind of automatically going to get you to that place. I think there's a number of different paths that you see at different levels, if you like. For people coming in as associates, they'll frequently be people who've actually worked in a startup for a period of time, and have been part of usually a reasonably early stage team, and have really, if you like, been at the coalface for a couple of years. The other path that you'll see is people who perhaps have spent a couple of years in an investment banking firm, frequently in a kind of an analyst role in an investment banking firm, and that can be a path. The other thing that I'd say is, putting some time and effort into building your network is incredibly important. not not that many VC jobs, even at the associate or analyst level, get advertised. A lot of them are just filled from the network of the partners, and
Hopefully the
that's
Irish Graduate Network can help, Brian.
yeah, well, potentially, exactly. And, the other kind of networks that I think are very helpful are the networks around kind of incubator and accelerator programs. So, for example, if you've got a skill set that might be useful on an accelerator program or something like that, then maybe giving some time to be a mentor or to help out in some way can be pretty useful. I think at partner level, direct partner recruitment, as you can imagine, is even rarer. And I think usually the people who are most successful in terms of that kind of direct partner recruitment tend to be people who have been entrepreneurs and have been reasonably successful entrepreneurs, or perhaps have been in very senior roles in entrepreneurial businesses, but I generally sort of say to people, look, don't hang your hat on becoming a partner in a venture capital firm, because even if you go in as an associate, a lot of firms, the way that they operate is they kind of hire a lot of associates on the assumption that most will probably stay for 2 or 3 years and then move on to something else. And there are relatively few that kind of, if you like, move up the grades and make it to partner.
Yeah, understand. Maybe just one more question, Brian, before we bring Avice in to let some of the attendees ask some questions as well. Just in terms of the startup ecosystem in Ireland, Brian, I do think it's fair to say that very few, if anyone, has done as much to promote this as yourself. I think it's something that's quite topical at the moment for a host of different reasons, but I think the Irish government can do more to recognise and support the risks and sacrifices that entrepreneurs take and make. So you might just share some thoughts there and perhaps some changes you'd like to see implemented.
Yeah, so I mean, firstly, I think I'm hugely committed to the idea that entrepreneurship really, really matters, and matters in a very big picture kind of way. And it's not just because entrepreneurship kind of creates wealth. It's because I believe it helps us to solve the great societal challenges that we face in terms of global warming, in terms of poverty, all of these things. It delivers better goods and services at cheaper prices, which raises living standards. So I really believe in the importance of entrepreneurship. I also think it really matters for a country to have a reasonably successful indigenously controlled enterprise base, and I think one of the challenges for Ireland is we've been enormously successful at, if you like, creating a product to attract FDI, but that means that our economy is now enormously dependent on primarily US multinationals, and I don't think that's healthy. So I would like to see the government do a lot more to encourage entrepreneurship. And I think there's a number of different kind of vectors to that, if you like. I would love to see much better tax treatment of share options, in particular for early stage companies. because I think that encourages people to kind of consider a career in early stage businesses rather than a career in Google or Amazon or Microsoft, So I think that's enormously important, and access to talent is one of the kind of the key pillars that we need to focus on. We also need to be able to attract talent from abroad, so we need to have a structure that enables that. The second thing is that I think if you look at any country that's been reasonably successful in this space, they generally have strong angel capital markets. The reality is it's incredibly hard to make money doing seed stage investments as an angel. So practically all jurisdictions have really strong tax incentives to encourage people to invest in early stage businesses. And ours are way behind by comparison with many other jurisdictions. So I'd like to see some significant improvements to the EIS scheme to encourage, if you like, not quite the man in the street, but the doctor and the dentist and so on, who have a few quid to spare, to think about investing that money in kind of early stage Irish businesses. More broadly, I think it strikes me as slightly insane that the rate of capital gains tax is exactly the same on a speculative property investment versus the kind of the blood, sweat, and tears that goes into building a business. So in the long term, I'd like to see actually two separate rates of capital gains tax. One that applies to entrepreneurial gains, the gains based on building a business, which in many cases creates huge value for the economy as a whole, versus purely speculative investments. So those would be some of the kind of the big things. I'd also probably like to see us be a little bit less, let's say, statist. I'm very positive about the role of Enterprise Ireland, but I think that perhaps the role of Enterprise Ireland is more dominant in shaping the ecosystem than it should be. So I'd probably like to see that role reduced, or maybe less focus on investment if you get the incentives for angels right.
Hopefully, post the new government been formed, this will be high on the agenda of the next Minister for Finance.
I think it has to be, because unfortunately, as a result of the COVID-19 crisis, there's going to be real problems for an awful lot of early stage businesses, and also real problems for a lot of existing investors, because they have portfolios of companies that are very, very challenged, and they're kind of looking at that portfolio and saying, do they need more capital rather than focusing on new investments? So I really think the government needs to think about, how do we drive capital into the market? How do we make sure there's enough capital available?
Very good. That was great, Brian. Thank you very much for...
No problem. Hi, Avice.
Hi, nice to meet you. Thank you so much for joining us.
No problem.
So we have a lot of questions, and I think one that people are very curious about is what made you decide to go public to raise funds for Draper Esprit, as opposed to the more traditional ways that people would go about it.
Great question, and I suppose there's a number of different things. I mean, firstly, in terms of the fundraising side, raising a VC fund typically takes about 2 years, and it's seriously hard work. And one of the reasons for that is that the pool of investors that are prepared to invest in an enormously illiquid 10-year GPLP fund, where they have no liquidity along the way is actually very, very limited. And we came to the conclusion that by going public, we would open up the asset class, if you like, to a much, much wider group of investors who would never have done a 10-year fund, but were quite happy to invest in a structure where they could effectively, if you like, get liquidity at any time, you know, subject to the market. So that was part of it. But we were also seeing that there were a lot of deficiencies in the 10-year fund structure anyway. You know, to give you one Irish example, one of my kind of big successes within Draper Esprit was a company called Movidius, which was acquired by Intel for about 400 million. And that company was 13 years old when it was sold, and had only got to revenue in the past, the final 3 years of that journey. So it's been a long journey of kind of building a lot of very, very deep IP. And the kind of the early investors in that, you know, with 10-year funds, they were in deep trouble, and a lot of them actually got washed out. So we kind of realized that, you know, often creating great businesses takes a bit longer than 10 years, you know, trying to squeeze that into a kind of a totally artificial time horizon didn't make a lot of sense. The other kind of big issue was that in a VC fund, you've got a fixed capital envelope. You know, you've got 100 million in the fund. You're not allowed to put any more than, say, 10 to 15% into any one business. So if you have a huge winner in the fund, you actually may not be able to invest as much as you would like into that company, which is also not a good thing. So going public enabled us to kind of eliminate those restrictions as well.
Perfect. Okay, I think we have a lot of questions kind of regarding this whole path into getting into VCs, but also for people that are trying to get in touch with VCs who are starting a company. Mm-hmm. So Patty wants to know, as a VC, what characteristics do you look for in a first-time founder who has no track record, or especially those without significant work experience?
That's an interesting question. I mean, actually, just relatively recently, I invested personally as an angel in a company called Robotify, and that was, you know, two, I'm going to say, kids dropping out of DCU. Actually, one of them is finishing off his degree part-time, and the other founder has actually dropped out. And, you know, there were a couple of things that really impressed me there. I mean, firstly, the two guys, they are guys, were hugely passionate about what they were doing. You know, they really believed in the opportunity, and they communicated that belief in the opportunity. The other thing that I was incredibly impressed with was the progress that they had made with very, very little in terms of resources, and the journey that they had been on in terms of thinking about the scalability of their business, you know. And this may sound a little bit counterintuitive, but they had effectively ditched two previous kind of versions of the business because they realized that the path that they were on was not scalable, you know. And on one hand, you might sort of say, so like they got it wildly wrong twice, but the thing that actually impressed me was their thinking about the scalability of the business. I mean, I think the other characteristic is, frankly, ethics and character. I think if you talk to most VCs about the mistakes that they make, I'd say they probably fall primarily into two broad categories. Market timing, where you are either too early or too late targeting a market opportunity. And unfortunately, being too early is usually every bit as fatal as being too late. And the other big category is people just backing the wrong people. So, getting an understanding of the kind of the character of the people that you're investing in is huge. I think if you're a 21-year-old college dropout, it's going to be a bit harder to raise money than if you're a 28-year-old who spent 6 years working in an entrepreneurial startup and so on. But I don't think it's a barrier if you demonstrate the passion and the ability to get things done.
And going off of that passion and a little bit of scrappiness that it takes, Daniel says that in the US, venture capital getting cold emails from startups to investors is a no-go. What would you say the protocol for trying to build a seed round would be here in Ireland?
Yeah, so I mean that's largely true, and I think to a great extent it's probably true in Ireland as well. I think you cannot beat a warm introduction. If Jim Mountjoy or somebody calls me up and says, Brian, would you meet this woman? I think she's got a really, really interesting idea. Really appreciate if you give her an hour. I'm going to do that. I am absolutely going to do that. If I get a cold email with no kind of reference or background whatsoever, it better be a seriously compelling email. I mean, I think again, networking helps a lot. Not all VCs, but some VCs, will float around at startup events and chat to people. But the thing I'd say more than anything else is, some people will say, I can't get a warm intro. It's your job as an entrepreneur to get a warm intro. That's where the kind of the hustle comes in, if you like. And in a funny kind of way, if you can't get a warm intro, it maybe says something about your hustle and your ability as an entrepreneur.
Yeah.
I would say don't be afraid to approach investors directly, though. And one of the techniques that people that I definitely believe works is, there's an old saying in the VC world: if you want advice, ask for money. If you want money, ask for advice. So a great tactic is to kind of say to an investor, look, we're not fundraising at the moment, but I'd really love to run our idea past you and tell you what we're doing and get your input. Now, it's so transparent, right? But it still works,
Mm-hmm. Perfect. And then Mark would like to know if CRO to VC is a common track.
CRO to VC, I wouldn't say it's a common track, but it is definitely a track that you do see from time to time. I would say you see quite a lot of people who are coming from a sort of CRO, growth marketing, those kinds of roles. But I wouldn't say it's hugely common.
Great. Someone else. Brian wants to know if saying that venture capital seems like something you fall into rather than get into would be a fair assessment.
Um, I wouldn't really say that that's fair. You know, maybe I kind of overplayed that slightly. I'm just very cautious of sort of saying to people, oh yeah, if you want to be a VC, here's a route that'll get you there. You know. So I do think there are things that you can do if that's something that you're interested in. You know, as I was saying, you know, doing some mentoring or maybe working in an accelerator or an incubator or whatever. You know, those are definitely things that'll help you down that path. But you know, how many new people get recruited into venture capital in Ireland each year? 1, 2, you know, so it's hard.
Yeah, completely. And then Yura wants to know, what practical skills do you think all entrepreneurs should focus on developing early in their career?
I think the most important skill of all is selling. You know, if you're an entrepreneur, even if you're not a salesperson, you're in the business of persuasion every day, all day. And, you know, you're persuading that great new hire to join your team. You know, you're persuading that customer to part with their money. You're persuading your team, you know, that this tough time that we're going through is, you know, a bad time in a great company, not that it's a bad company. And I think people underestimate sales as a skill that can be learned. You know, they underestimate the value of a consultative approach to selling, for example. So I think that's probably the number one skill, and it's probably the thing that an awful lot of founders are lacking where they come from, when they come from very you know, very technical backgrounds, perhaps. And the other thing that I would say is, you know, you need to learn to read a P&L and a balance sheet. You know, you don't need to be an accountant or a financial expert. And, you know, I'm certainly not, like, you know, I'm an engineer, but you need to have a reasonable level of kind of financial literacy so that you at least know, is your business model gross margin positive, you know, as a really good starting point, you know.
Mm-hmm. And then you spoke about trying to get good people on your team. And earlier you were speaking about how you found your co-founder, Gary, and the luck that you had with that. Do you think that you can make your own luck? And Emily wants to know, if so, how do you make yourself more lucky than your peers?
So, I mean, I think it was Gary Player who famously said, the more I practice, or the harder I practice, the luckier I get. And I totally believe in that. You know, you make your own luck by working hard, and by putting yourself out there, and by pushing yourself beyond your comfort zone, you know. So I think that really matters. I think there, you know, like in terms of things like the sales skills and the persuasion skills, you know, go do a course. One of the things I did relatively early on in my own first business was I did like a 3-day sales training program. You know, probably the best 3 days that I ever spent in my life, you know. And I think one of the other big challenges for entrepreneurs always is to distinguish between working in their business and working on their business, you know. And when you take 3 days out from, if you like, doing what you normally do to kind of to do a sales training program or something like that. It can feel, it can almost feel like you're not doing the right thing, like you're not you're not creating value, and actually you're probably creating infinitely more value because you're working on the business rather than just working in it, you know.
Mm-hmm. Completely. And then we have a couple questions about government and COVID as well. So Sean Casey would like to know, do you envision government directly stepping in to support the startup ecosystem? For example, taking equity stakes in high growth businesses during COVID-19?
So, I mean, there are already a number of support programs that have been announced for startups. The main one being what's called a Sustaining Enterprise Fund. That is primarily relatively low cost debt rather than equity, but there are elements to it that are equity driven. I think I would like to see that deployed a lot quicker, and I do think that the government needs to step in to make sure that there's enough capital available to support these businesses. And you know, remember, if let's say you had a company like Movidius, which had spent 9 years investing in R&D and had maybe spent 50 million on that R&D. If they go out of business because of the lack of availability of capital, then you know, not only have you a huge opportunity cost, but you've also just written off 50 million worth of research and development that has the potential to produce huge growth and upside for the economy as a whole.
And then going off that, someone who didn't leave their name, unfortunately, is wondering if a company has been funded by Enterprise Ireland, does it signal that it's worth investing in?
I don't think it automatically signals that it's worth investing in, but I mean, in an Irish context, Enterprise Ireland invests in a very kind of broad range of companies. So I'd kind of flip the question and say, if the company doesn't have Enterprise Ireland investment, you'd probably ask the question, why, you know? And that doesn't mean that if they don't, they're not worth investing in, but you do want to understand, so, you know, is there a reason why you have not taken Enterprise Ireland investment? And it might be a choice that the founders make, but you certainly want to know why.
Mm-hmm. And then we'll just have 2 more questions because I am conscious of your time. But someone left a very specific question with no name, but it says, "Hi Brian, what do you suggest for someone who's working as an analyst with a first-time fund with an unconventional investment thesis, currently raising money, wearing multiple hats but uncertain with the fund's future timeline?"
That's a very hard question without knowing a little bit more in some respects. I mean, I think it's a pretty tough time to be raising a first time fund. I do believe in the opportunity around funds with, if you like, an unconventional thesis. And I mean, in Draper Esprit, we've a fund of funds program where we've invested in a lot of funds, and we do fundamentally 2 things. We invest to give us geographic coverage, you know, where it'll enable us to see a lot of the early stage deal flow that we wouldn't otherwise if we don't have boots on the ground. And then, you know, novel investment thesis. So, for example, I'm a personal investor, and Draper Esprit are also an investor in a fund called Join Capital based in Berlin, which is very, very focused on kind of Industry 4.0, and in particular has very strong links into the German Mittelstand companies And a big part of their proposition to their investee companies is we can bring you to those German industrial companies and help you build those relationships. So I think if you've got a really strong thesis like that, you have a better chance of raising a first-time fund than if the thesis is very generic. You know, I think it's very, very tough to kind of raise a first-time fund with essentially a Me Too thesis. You know, timelines these days are definitely kind of, you know, can easily be 2 years, to be honest. So that does make it tough in terms of certainly, especially first-time funds where you don't have an existing stream of management fee income, you know.
Thank you for that. And then the final question, which I'm sure everyone's curious about with all of the time on their hands. Other than the Lean Startup, Simon would like to know if there are any books that have made a big impact on your life.
One of my absolute favorite books of all time is a book called How We Know What Isn't So, and the subtitle is The Fallibility of Human Reasoning in Everyday Life. And I'd kind of characterize it as being a little bit like Thinking Fast and Slow by Daniel Kahneman, but much more distilled, and I think much more focused and more useful than Thinking Fast and Slow. And I think it's a book that almost anybody who thinks of themselves as an intelligent person should read. You know, I think it will just highlight so many sort of flaws in your own thinking and opportunities to kind of to develop your own thinking. So that would be my kind of number one pick. And for leisure, Hilary Mantel, I think her books are just absolutely fantastic. And the thing that really appeals to me about them is the sense that, you know, Thomas Cromwell and his contemporaries were effectively modern minds. You know, they weren't Neanderthals. They were modern minds in a different time, and I think that comes over extraordinarily well in those books.
Perfect. Well, thank you so much for your time.
Not at all. You're more than welcome. I hope people got something useful out of it.
Oh, sorry, wait, one more. Someone's very eager for this one. What is the best return you ever got in an investment?
Best return. So I have not had, so in terms of realized returns, about 10x. My kind of last, I stepped back from the day-to-day in Draper Esprit, but my last Draper Esprit portfolio company was a company called Graphcore, which is an AI chip company, and that is my first unicorn. It's currently valued about 1.3, 1.4 billion. And I think, if I remember correctly, our initial investment there was at about 16 million pre-money. So now it's a business that's quite capital intensive, so it's raised a fair amount of capital, but that's sitting on a nice multiple right now, and hopefully we'll get to a hugely successful exit.
Fingers crossed.
That's it. Thank you.
Brian, thanks so much for giving so generously of your time, and I know the feedback in the Q&A chat here is already really, really positive, so couldn't be more grateful for you taking the time.
No problem, Tanner. As I said, I hope people got something out of it, and thank you, Avice, as well. It's Avice, is that correct?
Yeah,
sorry,
that's okay. Everyone does it.
Thanks. Thank you both very much. I enjoyed the chat, and hopefully people got something out of it. So thanks very much.
Thank you so much.
Thanks, Brian. Bye-bye.
Cheers.